value is sort of traditionally conceived is to almost force rank a universe of securities on some accounting variables relative to price. And as the structure of the economy has shifted, the ability for accounting data to accurately capture the economics of a business has arguably been eroded a little bit. And so it's very important to focus on value creation as opposed to just statistical value. And so at First Eagle, we start first with the business, and then we think about price. And I think that's a very important distinction. And we have a lot of institutional memory on businesses that have the kind of character that appeals to us. And I think you really have to start almost with the mindset of someone who's going to do a taxonomy of businesses. And the primary evidence for the existence of intangible assets that are valuable is a margin structure that in one way or another is superior to other players in that industry, because that's prima facie evidence, if you will, of scale advantages or pricing advantages because of product attributes. We also are very focused on cash flow generation. We do what we call the cash flow audit of a business, and we look at the cash flow generation of a business over a decade or so and see how that cash flow is deployed. And that shows us two things. Number one, it shows us the resilience of cash flow generation, and obviously advantaged assets tend to have more resilient cash flow generation. But it also shows us the second intangible asset, which is the extent to which there's management acumen at work here, whether they're taking the cash flow that's generated by the business and they're deploying that sensibly. And we can sort of drill down, if you will, and see, are they deploying that capital when they're investing organically to areas where they have core competitive advantage? And if they're deploying capital inorganically, what's the track record of value creation with the M&A that they've done? Have they managed to achieve decent returns on that capital? And to the extent that they are good businesses, have they appropriately distributed cash flow to shareholders? Most businesses, either if they're commodity businesses or they're great businesses, management teams should distribute the capital, because if you're a commodity, you don't really have advantage reinvestment opportunities, and so you should have a high payout ratio. If you're a franchise business with very valuable intangibles, you're going to have very high incremental returns on capital. So you're not going to need to retain a lot of capital to grow at a measured pace. And so therefore you ought to be able to distribute. And so we look at the history of capital distribution and the willingness of management teams over time to countercyclically buy back stock when it's out of favor. And so there's a range of tells when we're looking at businesses, but it really comes down to the character. Is there some basic evidence of incumbency, of stable market share positions over time? And you often don't get market share data from an annual report. We have to look at various sources to try and interpolate that. And then is there evidence in the cash flow generation and margin structure of the business over time? And has that cash flow been appropriately stewarded? Those are some of the things that we focus on.